Good afternoon, everyone, and welcome. Thank you for joining us today as we talk about the political landscape and the markets for this exclusive Evans May Wealth webinar with Michael Townsend. Michael today will provide his insights on three key items. Number one, the Fed's interest rate hikes, which is certainly top of mind for all investors. Secondly, recent congressional activity, including the Inflation Reduction Act, tax changes, and retirement savings updates. And last, but certainly not least, we are 13 days away from midterm elections. He will cover this and anticipated market performance in different political scenarios. If you have any questions at all for Michael during the webinar, please ask. That's why we do this. You have the ability to enter those with the Q&A feature that you can find by hovering over the bottom of your screen. We'll make sure that we have time at the end of the webinar for Michael to address your questions. I have to note that this webinar is being recorded, so if for any reason you need to step away or would like to revisit this or share it with family or friends, you will find a replay of the video on our website, evansmay.com. So to begin, I would like to introduce our special guest, Michael Townsend. It's a big deal that we have Michael here with us today. Michael has been with Charles Schwab now for more than 20 years. We were just talking before this launch, I think 22 years to be exact, and heads up legislative and regulatory affairs. He's spent more than 28 years keeping a pulse on Washington and helping investors understand how policy and politics in Washington affect the markets and, importantly, your investments. Prior to Schwab, Michael began his Washington-based career by serving as an aide to Senator Bill Cohen, a Republican out of Maine, and later served as press secretary and legislative assistant to Senator Susan Collins, also a Republican out of Maine. Prior to that, he spent 3 years at Townsend, a Washington, D.C. public affairs firm, where he ran financial services, legislative, and regulatory issues group. So he is certainly an authority on all things Washington. Michael, thank you so much for joining us today. We are excited to have you and to hear your insights on current political events and what that means for investors. So without further ado, I will pass the baton over to you and let you take it away.
Thank you so much. And hi, everybody. It's great to be with you. I'm talking to you from just outside Washington, D.C. I'm usually in my downtown office, but I'm a little bit on the road up north of D.C. Today because I'm going to be talking to clients up here for dinner tonight. So great to be with you. My name is Mike Townsend, and at Schwab, we have a little office. There are 5 of us, and it's our job to watch what's going on Capitol Hill, in the halls of Congress, at the White House, at the regulatory agencies like the SEC and the Fed, and really just try to figure out what it all means for investors. And I consider my job is trying to help you cut through all the noise and the nonsense that comes out of Washington. And believe me, there's a lot of both. And try to kind of figure out what really is worth paying attention to. So that's what I'm going to do today. I'm going to share my screen here. Give me 1 second to get that up and going, and so that you can see my presentation, and then we'll get into it. I'm going to talk a little bit about what's going on Capitol Hill. We'll talk about some of the regulatory issues and the Fed, and then, of course, we'll talk about the midterm elections. Yeah, just 13 days away. Incredible to imagine. But I'll start with Congress because, you know, with the incredibly close partisan divide that we have in Washington, we've got a single-digit majority for the Democrats in the House of Representatives. Of course, we have a 50-50 tie in the Senate. That just makes it really difficult to get much done. But interestingly, in the last few months, Congress has actually come together and gotten some stuff done. And I think it kind of kicked off earlier this year when Russia invaded Ukraine, and Congress quickly passed 2, and then more recently, a 3rd aid bill to support Ukraine to the tune of $66 billion in aid so far. That's military aid, of course, economic aid, humanitarian aid, and no surprise, overwhelming bipartisan support for supporting Ukraine. And, you know, I think that kind of helps free up some energy for working together on Capitol Hill. Because as we moved into the summer, we saw the first bipartisan gun legislation in more than 20 years. We saw a major veterans health care bill, And then we saw a really significant bill that hasn't gotten a ton of attention that is designed to help the US semiconductor industry and to help us be more competitive with China. So just a few words about that legislation, which is now law. It includes about $52 billion of direct support for US semiconductor manufacturers. And to give you a sense of how important that is, within a week of that law being signed into law by the president, we saw Intel open and break ground on a $20 billion manufacturing plant in Ohio. We saw Micron break ground on a $15 billion semiconductor manufacturing plant in Idaho. TSMC, which is the big Taiwanese semiconductor manufacturer, they're building a plant in Arizona. They'll get some money out of this. So this is really kind of a direct injection of support to US semiconductor manufacturers. The second part of this bill, about $200 billion, will go to just various initiatives to help make the next generation of young, talented researchers, technologists, and scientists to be able to compete with China on cutting edge fields like artificial intelligence and quantum computing and rocketry and space exploration. And the way that's going to manifest itself is through funding all the way down to the high school level to build up STEM programs and that sort of thing. Research universities to help them partner with businesses in their communities and create these sort of tech hubs in different cities around the country, and really just try to churn out the next generation of talented leaders in these fields. So that's also a really important piece of legislation. And then, of course, we had the Inflation Reduction Act, which was not at all bipartisan. The Democrats used a special set of rules in the Senate to bypass a filibuster and make it possible for that to pass without a single Republican vote. And then it passed with no Republican votes in the House either. $750 billion in that package focused on climate change, on some healthcare provisions, and reducing the deficit. And I want to talk a little bit more about exactly what's in that bill. But first, I want to provide a little context for you to think about how, when a big law like this passes, how there's a lag for getting that money out into the economy. And a good example is that about a year ago, Congress passed the bipartisan infrastructure bill. That's spending of about $1 trillion on roads and bridges and airports and railways and expanding broadband access to rural areas. Lots of kind of just traditional infrastructure spending. But it was only in August that the White House announced the first 166 projects that are going to be funded by this plan. And that's indicative of the kind of lag there is. Really, the bulk of that infrastructure money is probably another 2-3 years down the road because of the complexity of infrastructure planning and permitting processes and competitive bidding and all that. It just takes a while. And I use that to provide some context on the Inflation Reduction Act, because that bill passed and became law in August, but much of that money is geared at combating climate change, about $370 billion of it. Largest expenditure Congress has ever made to combat climate change. But the way that money is going to get out there is through all sorts of initiatives around, greening our manufacturing process, and all the way down to, helping communities buy electric school buses and that sort of thing. But it's a ways away from getting that money sort of out there and operating in the economy. So that's just some perspective on how there's a big time gap between Congress making a major initiative and that money really being felt in the economy. The other thing to know about the Inflation Reduction Act's climate change provisions, a couple of things for individuals to note. One is that there is a tax credit that has been extended and expanded for home improvements in the energy efficient mode. So meaning if you buy energy efficient appliance or energy efficient heat pumps or windows, or you put solar panels on your roof, those kinds of home improvements will be eligible for a tax credit, and that will continue to happen each year. The second one has probably gotten even more attention, and that's the new $7,500 tax credit for the purchase of an electric vehicle. A couple really important things to know. If you're thinking about an electric vehicle, you need to read the details and do the research for this tax credit, because number one, there's an income cap on who's eligible for it. Number two, there's a cap on the price of the vehicle. So $55,000 and under for an electric car $80,000 and under for an electric SUV, truck, or van. But the really important one has kind of two parts. One is that the vehicle has to be manufactured here in the US. And that means right off the bat, it takes out electric vehicles that are made by BMW and Hyundai and Kia that are not manufactured here. Hyundai just announced that they're opening a electric vehicle plant. They're going to build an electric vehicle plant in Georgia, but it's not expected to be open until 2025. I think that's partly in response to this legislation. The other thing, and this is a really complicated one, is that the battery has to be sourced from the US or from a US trading partner. And that means the minerals that go into the battery too. And today, the vast majority of electric vehicle batteries are sourced from China. And that makes any car using that battery ineligible for the tax credit. So just to say, you're going to have to kind of look into this before you think, oh, I'm going to get a $7,500 tax credit, because the government is about to put out a list of which vehicles are eligible for that tax credit. And it's going to be pretty short because there aren't a lot of vehicles that qualify yet. So just something to know about those provisions. The other aspect of the Inflation Reduction Act, I think, is getting a lot of attention in the media. You may have seen, depending on where you live, political ads around this, but is this idea that there's an $80 billion increase in funding for the IRS. And you may have seen these ads or read these articles that talk about how, the IRS is going to hire 87,000 armed auditors who are going to storm the streets of suburbia looking for tax cheats. I don't think that's quite what's going to happen here. The first thing that's going to happen is they're going to hire people to answer the phone, because you have like a 1 in 10 chance of your phone call to the IRS ever being picked up. They're going to hire people to process a huge backlog of unprocessed returns. They just need people to sort of help with customer service. But I do think down the road a couple of years, that the goal of this increased funding is to close what is known as the tax gap. It's essentially the difference between what is owed in taxes and what is actually collected in taxes. And the way you do that is you hire more auditors and you try to get wealthier people to make sure that they're paying their fair share of taxes. So I do think down the road a couple of years that the wealthiest filers will start to see an increased chance of audits. Now, keep in mind, this is still a very tiny chance, but maybe a little bit less tiny than it was last year. So that's the IRS funding. The Inflation Reduction Act was a huge compromise for the White House. They had lots of big ideas. The president talked about all sorts of programs that he wanted to include: national paid leave, free community college, universal pre-K, more funding for childcare and elder care. And a lot of that stuff had to be dropped over the course of this, just because, to get it in a reasonable size pack. So that's the Inflation Reduction Act. A couple of other quick economic things. I think everybody's probably familiar with the president's order to waive $10,000 in student debt for people, $20,000 if you have a Pell Grant. That is in the process of being launched, but is currently in a hold because of a court challenge that needs to be ruled on. And I expect there's going to be a fairly extensive court challenge to this, and the outcome of that is unclear. But right now, that program's in limbo a bit. The other thing that Congress recently did was, Congress by the end of September every year is supposed to pass the 12 appropriations bills that fund every federal program and every federal agency. They have to do that by the end of September because the federal government's fiscal year starts on October 1st. And if they don't, then that's when we get into the potential government shutdown scenario. Well, this year, they passed exactly 0 of those 12 bills by the deadline. But not surprisingly, nobody wanted to shut down the government right before the election. So what they did is they passed a temporary measure that just kind of keeps the government funded at the same rate as it was last year through December 16th. So what that means is that we have a new government shutdown deadline of December 16th. So Congress is going to have to come back to Washington after the election and deal with that and some other issues that I'll talk about in just a minute before breaking for the holidays, and then the new Congress will be sworn in January. So no chance of a government shutdown until mid-December. And then the one other thing that I think the markets are starting to kind of have their eyes on is the fact that sometime next year, Congress is going to have to raise the debt limit. And what that means is that there is a cap on how much debt the United States can accumulate. It's north of $31 trillion. We're about to hit that cap. And that means that Congress is going to have to pass something that raises that cap so that we continue accumulating debt and not defaulting on our debt. The market does not like uncertainty around the debt limit. And this has echoes of 2011, when we got the closest that we've ever gotten to defaulting. S&P, Standard & Poor's downgraded US debt for the first time in history. There was a lot of market volatility around that uncertainty. We could be looking at another scenario like that in 2023. So that's out a few months, but it's definitely something that I'm keeping my eye on. I wanted to talk just for a minute about taxes, because taxes have been on kind of an interesting journey over the last year. When the bill that became the Inflation Reduction Act started, it was a much larger bill known as the Build Back Better Act. And that original version, introduced about a year ago, focused tax increases on wealthy individuals. So it would have taken the top income tax rate back to 39.6%. It would have created a new cap gains tax rate for wealthy filers. It would have reduced the amount that you could exempt from the estate tax. But as that moved through the legislative process last fall, there was a lot of discomfort with that. And so those ideas sort of fell away. And the bill became more targeted at sort of the extreme wealthy. It would have created a surtax on income over $10 million and that sort of thing. In the end, that is all part of the bill that then collapsed in a spectacular heap in December, when Senator Joe Manchin of West Virginia, moderate Democrat, and Senator Kyrsten Sinema of Arizona just said, this whole package doesn't work for us and we're not going to support it. And in a 50-50 Senate, 2 Democrats walking away meant that it couldn't pass. So we entered 2022 without really many prospects of this coming back to life. And I think that was true for about 6 months until we got to the summer, and all of a sudden it did come back to life. But importantly, when it came back to life, it didn't have any individual tax increases in it. Instead, the focus was on corporate tax changes. And that's what passed Congress and is now law. So 2 new corporate tax changes. One is a new 15% minimum corporate tax. The way that's going to work is large companies, $1 billion of income, of a profit a year for 3 years in a row. Any company above that line that is paying less than 15% tax rate will have to come up to 15%. Think of it kind of like the alternative minimum tax. It's sort of a floor. And there's a lot of companies, major companies, that will be potentially impacted by that. Amazon.com, Apple, but also non-tech companies like Verizon, UPS, General Motors, and others will have to pay a little more in taxes starting next year. And then the other element was a new 1% tax on stock buybacks that goes into effect in January. You may see a flurry of buyback activity by companies here in the last couple of months of the year to try to get in ahead of that tax taking effect. But the sense here in Washington is that a 1% tax on stock buybacks is probably not going to be a big disincentive for companies to continue buyback activity. It may make them think twice about it, but it doesn't seem like the business community is thinking that that's going to be a huge game changer. The other piece of legislation that I wanted to mention is that Congress is working on a bipartisan basis on a fairly interesting retirement savings bill. It's gotten known as Secure Act 2.0. The Secure Act is the bill that passed in 2019 that raised the age at which you have to take a required minimum distribution from your retirement account from what was originally 70 and a half up to 72, where it is now. Well, this new version would take that age up to 75. The question that we don't know the answer to yet is exactly how it would do that. So a version that has already passed the House of Representatives with overwhelming bipartisan support, 414 to 5, that bill would do so in a step-stair fashion. It would take the required minimum distribution age to 73 next year, to 74 in 2030, and 75 in 2032. The Senate bill would just go straight to 75, but not until 2032. And that's kind of seen as a little odd here in Washington to push something out a decade. So House and Senate are kind of negotiating behind the scenes to come up with a compromise. I expect we'll see something kind of more in the middle on that, but I do think there's a good chance that the required minimum distribution age will get hiked. We just don't know when that will start and go into effect. Also, the bill will allow people in their 60s who are approaching retirement age to contribute even more in what is known as a catch-up contribution. That would be increased. And then there's lots of good stuff in this bill for retirement plans like 401k plans to help businesses start a plan or improve their plan, to help employees get better access to the plan, that sort of thing. So lots of good stuff in this retirement bill. I think there's a really good chance that this passes in December, probably attached to some larger spending bill. This is how things happen at the end of the year. You kind of have this giant bill that gets all sorts of things attached to it. And I think the retirement bill is a good candidate for that. It's not a slam dunk, but it's something we're going to be watching carefully. And as soon as we know more about what the required minimum distribution age change may be, we'll of course be communicating that. And then finally, just here in the last week or so, the IRS announced the new inflation-adjusted tax provisions for 2023. And a couple of things to note. One is that the amount of assets that you can exclude from the estate tax is going to go up pretty significantly, from 12.06 million a person to 12.92 million a person in 2023. Also, the gift tax exclusion, the amount you can gift to, say, a child or a grandchild or something, will go from 16,000 this year to 17,000 next year. Also, all of the tax brackets will increase, meaning the income that you can make before you tip into the next highest tax bracket, all of those brackets will go up by about 7%. And then retirement savings contribution limits are going up significantly. For 401k plans, next year you'll be able to contribute $22,500. That's up $2,000 from current law. That's the biggest increase in history. And then if you're over 50, you can contribute an additional $7,500 on top of that, what's known as a catch-up contribution. A more modest increase for IRA savers, you can go from $6,000 in 2022 to $6,500 next year. And then finally, something that has perplexed financial planners and savers alike is new rules around inherited IRAs, particularly inherited IRAs for non-spouses, meaning child or grandchild who inherits an IRA. Under current law, you have to distribute the assets. You have to liquidate that account essentially within 10 years after you inherit it. And when that came out, everyone sort of looked at that and said, well, you could kind of do that in whatever way you wanted, even waiting 9 years and 364 days and doing it all on the last day if you wanted. However, the IRS came out earlier this year and said, no, you're supposed to take annual distributions from that over the 10 years. Now, this was kind of retroactive. So people were like, well, wait, I didn't know that I had to take one, so I didn't take one in 2021 or that sort of thing. So just recently, the IRS came back and said, okay, we're not going to penalize anyone who didn't take a required minimum distribution from an inherited IRA until 2023, meaning you get like a 2-year grace period, 2021 and 2022. So that's a little bit of clarification on something that had been kind of confusing for financial planners and for heirs alike. Switching gears, I'll talk a little bit about what's going on at the SEC. SEC, which regulates the capital markets itself and has all investor protection as part of its mandate, has a really busy agenda. They put out their sort of to-do list a couple of times a year, and their most recent iteration had 53 different issues that it was looking at. Bloomberg has called this the crackdown on everything, which I think is appropriate. But I'm not going to talk about 53 issues. I just want to talk about a couple that I think investors should know about. One, we're at the front end of what will be an interesting debate over sort of reforming how our markets actually work, the very structure of trading and such. And there are a couple different things going on here. One is that in the wake of last year's meme stock trading frenzy, where you saw GameStop Corporation and Bed Bath & Beyond and other kind of low-priced stocks go on these crazy roller coaster rides, there's been some concern at the SEC that it's become too easy to make trades on your phone, and particularly for young, new investors who maybe were sitting around during the pandemic and started trading on their phone, that it's become sort of a game. They call it the gamification of stock trading. And so I think we're going to see some rules that kind of crack down on that, maybe just make more requirements around educating investors before they can make more sophisticated trades. So I expect that to come out soon. And then the SEC is also looking at sort of what happens inside the pipeline between when you as an investor push trade on your computer and it disappears, and then it comes back and it says, here's what happened. And there's some concern about sort of what happens inside that pipeline. Are there conflicts of interest? Was there money changing hands? Did that affect where your trade got executed? And for investors, you're supposed to get what's known as best execution. You're the best outcome for your trade at the time that it happened. But it's hard for investors to know really whether they got that because they don't get a lot of information about what happened inside that pipeline. So the SEC is going to come out with some rules. I think will try to make that more clear. And then finally, the SEC has already proposed shortening settlement times. Today, when you make a trade, the trade settles 2 days after the date of trade. They are going to shorten that to 1 day starting in 2024. And then the other category that's getting a lot of attention is proposals that deal with environmental, social, and governance-focused investing, ESG investing, which in itself is something of a controversial topic these days. But the real controversy at the SEC is around a proposal they made earlier this year to require companies to disclose more to investors about their impact on the climate and their risks that they face from climate change in the future. And in particular, it calls on big companies to not only disclose their greenhouse gas emissions, but also go all the way down their supply line and sort of discuss the environmental impact of the different stages in their manufacturing process. Companies have really pushed back against this. I think they're worried that this is going to be A, really expensive, and B, really difficult to sort of quantify, and you end up maybe potentially misleading investors. What's interesting about this is that when the SEC puts out a rule proposal, they vote to put it out there, and then there's a public comment period, and anyone can comment in. And when you see a typical SEC rule, you might see 300, 400 comment letters or something like that. For this climate change one, 15,000 comment letters have come in, which I think gives you a sense of how controversial it is. So we're going to see what happens here. They're supposed to finalize that probably early next year. And I don't know whether that's something that's necessarily going to stand a court challenge, but it certainly may. So we'll see exactly how that plays out. And then finally, one other thing to mention, the SEC has proposed changes to a rule known as the names rule, which literally deals with the names that you can put on a mutual fund or exchange traded fund or such. And the way that they're going to do that is by expanding that rule to apply to words like green and sustainable. So if you're looking at the ABC Green Fund and the XYZ Green Fund, they may not be defining green in the same way. And so this will try to put some standards around that. The thing that the SEC did here is they kind of expanded that the words, and it's going to apply to all sorts of words that we all know are in the names of funds, like growth fund and value fund and international fund, which could be sort of confusing for investors. So we're going to watch also how that one plays out. And then the last issue I wanted to mention is cryptocurrency, just because it's become obviously such an interest to investors of all types. Washington is usually far behind in sort of catching up to whatever the newest trend is, and I think that's kind of the case here. But the reality is that there's a growing interest in Washington in sort of putting kind of a regulatory framework around cryptocurrency and putting better investor protections in place. They just don't have that right now. And so a lot of different agencies in Washington are looking at this, but there's some big questions, like who's in charge? Is it the SEC? Is it the CFTC, which is the Commodity Futures Trading Commission? You also have, Department of Labor saying, wait a second, we don't think cryptocurrency should be in an investing option in retirement plans. And we have Treasury saying, whoa, this is a risk to financial stability, and there's a lot of criminal activity being used with cryptocurrency, and we're worried about it being used for money laundering and that sort of thing. Fed is looking at this and saying, maybe we should get in this game and start a central bank digital currency that has the backing of the Fed. something central banks around the world are looking at doing. So a lot of different sort of moving parts here. The White House is trying to get its arms around this. They put out an executive order earlier this year that said every agency that kind of touches cryptocurrency or is touched by cryptocurrency, weigh in with your recommendations about the best way to kind of put a regulatory structure around this. But ultimately, I think this is something Congress is going to have to do. There's interest in Capitol Hill. There's some bipartisan bills to try to clarify this and put in those investor protections. I don't think that's going to get resolved in 2022, but I do think it's an issue that could get some momentum in 2023, particularly in a divided environment. This is an issue that has attracted bipartisan support. So another thing to watch next year. Just a few words on the Fed. I think we're all keenly aware of the Fed's aggressive series of rate hikes, 3 consecutive 75 basis point hikes to date. The Fed meets next week for its next meeting, and all signs point to a 4th consecutive 75 basis point hike. If you watch there's a little tool that you can use that sort of gathers that sort of sense of economists of what's going to happen. I think right now that the odds for a 75 basis point hike are 94%. So that seems like something of a slam dunk for the November meeting. The thing to watch is where the target is that the Fed wants to get to and then sort of slow down and level off. Right now, that target is a little north of 4.5%, but there's a growing sense that the Fed will probably have to go a little farther than that, maybe to 5.25%. We're at 3 to 3.25 right now, so that implies a pretty significant series of hikes still to come. And I think we've all heard the rhetoric out of the Fed that they are singularly focused on getting inflation under control. And even if that risks increasing unemployment, even if that risks putting the country into recession, they seem comfortable with that outcome in order to get inflation under control. Of course, the thing about the Fed is there is a lag there too. Fed policy and raising interest rates takes a while to kind of play out. So you're starting also to see in Washington almost the opposite reaction, worries that the Fed has gone too far and is being too aggressive and isn't giving time for its changes to sort of get absorbed in the economy. So all eyes are going to be on the Fed next week when they have their latest meeting to see exactly what their language coming out of that meeting is. Okay, well, let's get to the fun stuff here at the end, and that's the midterm elections, which are less than 2 weeks away. As I said, really narrow majorities, a single-digit majority in the House for the Democrats, of course, a 50-50 tie in the Senate. Midterm elections are notoriously terrible for the president's party. You see here, the president's party has lost seats in the House in 17 of the last 19 midterms, lost seats in the Senate in 13 of the last 19 midterms. In fact, if you go back to the Civil War, there have only been 4 midterms since the Civil War where the president's party, whatever party that was, won seats in the House, gained seats in the House. So huge historical headwinds here for the Democrats. Another historical challenge is President Biden's low approval rating. This is a chart that aggregates the approval ratings of President Biden in all the different polls that test that all the way through his presidency. And while there's been a little bit of an increase over the last 3 or 4 months, still well below that 50% line, around 42, 43%. Why does that 50% line matter? Well, this is a little chart that looks at the first midterm election of each president since Harry Truman. And the ones where the numbers are in red, those are the occasions in which the president's approval rating when the midterm elections came along was below 50%. And the average loss of House seats in that scenario is more than 40 seats. So we're talking, kind of blowout territory. So again, huge historical trends facing that the Democrats are facing as they try to retain their majorities. The other thing that's going on in this election, particularly as it pertains to the House of Representatives, is that this is a reapportionment year. So first election after the 2020 census. So you've got an adjustment based on population changes in terms of states that are losing population may lose a seat in Congress. They get 1 fewer representative in Congress than they have now. States that are gaining population gain seats in Congress. So you see here, the yellow states are the ones that are losing a seat in Congress. So come January, they'll have 1 fewer representative in the House than they currently have. California losing a seat in Congress for the first time in its history. And then you see that little cluster of Midwestern states, northern states, Michigan, Ohio, West Virginia, Pennsylvania, New York, and Illinois, all losing one seat. Texas is the big winner. Texas gains 2 new seats in Congress. And then you see the other purple states are the ones that are gaining 1 seat in Congress. Part and parcel with that, though, is the redrawing of congressional district lines across the country. And what's happened over the last couple of decades, and it's true no matter whether Republicans are in control, whether Democrats are in control of the process, whether there's an independent commission in control of the process, is that congressional districts have been incredibly gerrymandered to the point where there's very few truly competitive House races anymore. There are 435 House seats on the ballot on November 8th. And I would say that maybe 40 are truly competitive. So both sides have kind of a huge sort of already set kind of, close to 200 on each side. And everyone's focused on this relatively narrow group of seats that are going to determine the majority. Kind of a similar situation in the Senate. This is a map that shows which Senate seats are up in this election. 21 Republican-held seats, 14 Democrat-held seats. But what's interesting is that, when we think of presidential elections, we all pay attention to the 8 or 10 battleground states. We all know them. They're the handful of states that are sort of truly purple states, and they could go either way, and that the outcome in those states really determines who wins the presidency. Well, the same thing is going to determine, and those same states are going to determine which party controls the Senate, because the 6 states that were closest in Biden versus Trump in 2020, all 6 have a Senate seat on the ballot: Arizona, Georgia, Wisconsin, Pennsylvania, North Carolina, and Nevada. So I really think those 6 states are going to be the ones to watch. This is a little chart of those races and where the polls are right now. I added Ohio at the bottom of this list because Ohio is a very close race, and so that's another one to watch. But these are sort of the key races that I'm going to be watching. And you see from the latest polling numbers, I mean, this race in Nevada they're separated by 0.1% of a point. I mean, that's meaningless. It's statistically completely meaningless. It just means it's a complete toss-up race. In fact, most of these races are well within the margin of error. So these races could go in either direction. And I really think these races are the ones that are going to determine who controls the Senate. The other interesting thing in this year's Senate races is that there are several kind of unusual Senate candidates on the Republican side in that they've never held electoral office before. So that includes Herschel Walker in Georgia, the former Dallas Cowboy and Heisman Trophy winning football star, Dr. Oz in Pennsylvania, J.D. Vance in Ohio, who wrote Hillbilly Elegy, and also Blake Masters in Arizona. All 4 of those candidates have never held an office before. And historically, that's not a great recipe for getting elected to the Senate. There are certainly examples of it, but generally not having served in a government role is a better way to go for a House race or even for a governor's race, but not necessarily for a Senate race. So those are races that we're going to be really interested in watching what happens. One other thing to know about the battle for the Senate. In the state of Georgia, the winner has to get over 50% on election night in order to win the seat. If they don't, then the top 2 individuals go to a runoff election in December. In the Georgia race, there is a third-party candidate who's polling at 2, 3, 4%. That could be enough, given how close the race is, to keep both of the Democrat and the Republican candidate below 50% and send them to a runoff in December. That means it's possible we may not know which party controls the Senate after the election. We may not know until December. Recall that that's what happened in the 2020 election. There were 2 Senate races in Georgia, both ultimately won by Democrats in January in runoff elections, and those 2 results forged the 50-50 tie. So that's something to watch to see whether either candidate gets over 50% in Georgia. So what do we think is going to happen? I do think Republicans are going to take over the House of Representatives, both on polling and sense of momentum and historical trends. The size of that majority has maybe come down a little bit. Over the summer, we saw some Democratic momentum as gas prices came down for 3 months. before ticking up a little bit this fall. I would say the Dobbs decision by the Supreme Court to overturn Roe v. Wade has galvanized Democrats. But in recent weeks, some of that momentum seems to have kind of petered out for Democrats, particularly as inflation has stayed high. And that is clearly the number one issue for voters in every poll, is the high inflation number. So, I think it's pretty likely that Republicans will win a solid majority in the House. If I had to guess, I'd probably put that at, a gain of 20 or so seats. They only need 5 to get the majority. So if Republicans win the House, as I expect, I think you'll see lots of investigations of the Biden administration. You'll see, kind of score settling for perceived slights and ill treatment during their time in the minority over the last few years. But ultimately, House Republicans, if they have the majority, are going to have to work with the president on basic stuff like getting a budget done and that sort of thing. So they're going to have to find ways to compromise. In the Senate, as I said, I think it's a toss-up. I think 50-50 tie could be a real possible outcome here. Either way, it's going to be 50-50, 51-49, maybe 52-48, one way or the other. Not going to be an easy environment to get much done over the next couple of years. And then finally, remember that Joe Biden, as a president, has the veto pen. So even if Republicans win the House and the Senate, the president will be able to veto legislation, and neither the House or Senate will be anywhere close to a veto-proof majority to overcome that. Finally, I wanted to end by showing this chart, this chart gets at the question that I probably get asked more than any other question, which is some version of, what's the best political configuration for the markets? So we looked at the Dow Jones Industrial Average going back 120 years, and how did it perform on an annual basis under these different political possibilities? So the most common political configuration that we've had over the last 120 years is the one we have now. Democrat in the White House, Democrats with the majority in both the House and the Senate. But the second most common is the opposite, Republican in the White House, Republicans controlling the House and the Senate. And you see in that red circle, the difference in market performance in those two totally polar opposite scenarios, 0.5 percentage point. What I want you to take away from that is that the market doesn't care who wins the election. The market doesn't really care about the horse race and the margins. I'll be like, oh, it's 218 seats, it's 228 seats. The market doesn't care about that. The market cares about what Congress actually does. So when Congress passes a big infrastructure bill like they did last fall, the market likes that. Historically, infrastructure spending is good for the industrial sector. It's good for the materials sector. It's just good for big companies that make machines that make roads. It's that kind of intuitive connection. The market cares about the Inflation Reduction Act because at the end of the day, it's probably going to be good for companies that make wind turbines and companies that make solar panels and that sort of thing. So there's a kind of a direct connection between market reaction and what Congress actually does. There's not really a market connection between the outcome of the election. Yeah, you'll probably see some market reaction over the first few days after Election Day next month, but typically that doesn't last more than a week or so. So I say that just to, it's going to be easy over the next couple of weeks to get sort of emotional about the election outcome, about whether your team is winning or losing or did well or didn't do well. Don't let that kind of creep into your portfolio decision making. There's no way to kind of, have your portfolio set for this particular political outcome. It just doesn't work that way. So one other fun chart to look at, historically speaking, the best year for the market in the 4-year presidential cycle is the 3rd year after the presidency. That would be next year, in this case, 2023. Historically, the market has returned double-digit returns in the 3rd year after the presidential election, and it's been very consistent. Obviously, there's tons of other things going on in the economy right now that are affecting the market. So don't rely on this. It's just an interesting sort of historical anecdote. So with that, I'll wrap up. I'll just say that if you want to follow my commentary, you can find me on Twitter. You can also listen to a podcast that I have called Washington Wise. That comes out every other week. It'll come out tomorrow. Tomorrow's episode, we're talking about, what is the UK situation? What impact does that have on the markets and the global economy? What about China's recent party Congress and decisions made there, the Ukraine-Russia war, and the strong dollar? How does that impact things? So we're kind of having a global investing perspective in tomorrow's episode. I'll show my little required disclosures here, and then I think I'll stop sharing my screen and we can go back to see if there are any questions.
Okay, perfect. Well, thank you so much, Mike, for the commentary. Of course, everyone is concerned about inflation. Everyone's talking about the Fed. What can Congress do to slow inflation? As we think about what you do versus just what the Fed can do.
Yeah, this is a common question, and I think it's gotten worse because Congress just passed the Inflation Reduction Act, which may take a prize for the dumbest name for a piece of legislation in recent years. And believe me, there are a lot of contenders for that. But Congress just doesn't have the ability to sort of get things out there fast enough. This goes to that lag time that I was talking about, where passing something that focuses on different industries and getting boosting parts of the economy just takes a while to happen. And that's why you're seeing all the attention is on the Fed, because the Fed has the levers that it can pull more quickly. I mean, even the Fed can't move that quickly, and we're seeing that in persistently high inflation, despite the significant rate increases. So, I think it's just a reminder that nothing in Washington happens fast. And while people want a snap turn on inflation, I just don't think we're going to get that, and I don't think there's anything Congress can do to make that happen.
Okay. You mentioned earlier a big bill Congress passed to help the U.S. compete with China. Talk a little bit about the U.S. relationship with China, particularly as it relates to the rising tensions with Taiwan. How concerned is Washington about that relationship?
Yeah, it is a concern in Washington, and I think that concern only got more significant here in the last few months, while we saw a lot of exercises, military exercises by China in the Taiwan Strait, and those kinds of threats towards Taiwan. I will say that I don't think there's an overarching concern that China is imminently going to invade Taiwan. I think we'll see more kind of saber rattling and more exercises, but I don't think that's imminent for a host of reasons. But it's just one aspect of contributing to a really tough relationship right now between U.S. and China. China's not happy with that bill that passed, that's very specifically focused on competing in sectors that they really feel like they're strong in the economy. Obviously, we have human rights issues around Hong Kong and Taiwan, and the treatment of the Muslim minority in Xinjiang province in China. And then, of course, we have the trade issues that are always there, the trade imbalance. And I think it's notable that these trade tariffs that have been in effect since the Trump administration and have not been undone by the Biden administration, which I think is indicative that there isn't a huge policy change that has happened. So one thing I'm watching, the White House is reportedly trying to set up a meeting, a one-on-one meeting between President Biden and China's President Xi Jinping on the sidelines of the G7 summit next month, which will be in Asia. And if that happens, the two leaders have not met face to face. They have met over Zoom, as have we all over the last year or so. But if they sit down face to face, I think that would at least go a little ways forward in sort of creating a better dialogue. But there's a lot of concern about how difficult the relationship is right now, and the implications that could have for global economy and global cooperation and that sort of thing.
We have a question come in with regards to recession. So how likely do you believe it is that we have a recession, and what impact will we see if that does occur?
Yeah, recession is an interesting thing, because I think the media and that we all as investors get sort of overly obsessed with whether and when we're in a recession. The reality is you don't know you're in a recession until well after you're in a recession, because the MDER, who's kind of the official arbiter of recession, is a backward looking, kind of a thought process on it. So Do I think it's likely? It certainly seems likely given all the data. But I would also say that, this is a weird economy that we have right now. We don't have a lot of historic precedent for inflation being this high and unemployment being this low, for example. So not all the numbers kind of line up in a traditional way. So it makes it maybe a little harder to call. I certainly feel like we're probably headed that way. The question is, how important is it that we are or aren't in a recession? And I sort of feel like there's too much time spent on that question and not enough on sort of the underlying fundamentals of the economy and what direction they're headed. And I think by the time you know you're in a recession, you're probably already on the way out of the recession. And that's where investors sort of miss the opportunity, as because they maybe think, oh, we're in a recession, I'm gonna hold back. And that's probably the time that you should have been already getting back in the market.
There's such a focus right now on green energy, and with the emphasis you mentioned on the recent bill on green energy, how do you think that affects traditional energy markets going forward?
Yeah, there's kind of a tendency to fall in sort of a black and white winners and losers sort of equation here. And I think when it comes to energy, that's really a mistake because there's no question that this recent legislation, sort of boosts green energy over the next decade, say. But that said, we're still a long way from becoming, entirely dependent or anywhere near entirely dependent on green energy. We're going to have traditional energy and need traditional energy, gas and oil, and et cetera, for a long time to come. And I think there's a place of balance here where it's not, oh, I should be all in green energy or I should be all out of green energy. I think you want to be in both. And that's where obviously your expertise comes in and sort of trying to figure out what the right mix is and that sort of thing. But I certainly don't think this legislation really dramatically changes that at all. Yes, there may be some opportunities in over the next half a decade in some up and coming green companies, but I don't think that's at all a replacement of traditional energy.
Okay, great. Well, I think I have one last question that's come in from our clients, which is there a role for corporate profits in driving price increases?
In driving prices down?
In driving price increases.
In driving price increases, sure. I think that's, there's a lot of questions sort of as to, who's to blame here for inflation. And look, I think there's no question that things like the Russia-Ukraine war and certainly the supply chain challenges that we've had over the last couple of years have contributed to that. But, what's the role of corporations, which are supposed to make money for their shareholders, in taking advantage of that and hiking prices because, well, everyone's hiking prices and that sort of thing. So I don't know how you kind of riddle that all out, but I certainly think that's part of it. Companies aren't obligated to lower prices, just because, and historically they tend not to. So, we'll see obviously how it plays out in the next year or so.
Okay, great. Well, I think that was the last question. So, Michael, I'd just like to thank you so much for taking the time and sharing your insights. It's very evident that you have a pulse on all the action in Washington. And for all of those watching at home, we hope that this has been a valuable use of your time. Thank you again for tuning in and have a great evening. Until next time.